On the morning of September 15th, 2008, something happened that the people who ran the global financial system had spent the previous week insisting could not happen. Lehman Brothers filed for bankruptcy. Not quietly, not in the way that small companies disappear, into receivership, into reorganization, into a court filing that merits a brief paragraph in the business pages. Lehman Brothers collapsed the way buildings collapse. Suddenly, completely, and with a force that shook everything standing nearby. Within hours, stock markets around the world began to fall. Banks stopped lending to each other. Companies that had nothing to do with mortgages or investment banking found that the credit they needed to meet payroll had simply vanished. Within weeks, governments across Europe were nationalizing banks. Within months, the global economy had contracted in ways that had not been seen since the 1930s. Millions of people who had never heard of Lehman Brothers, who did not own a single share of stock and had never borrowed a dollar from a Wall Street institution, lost their jobs, their savings, and their homes. All of it traced back to one Monday morning in September. All of it traced back to a building in Midtown Manhattan that was no longer there. Its name stripped from the facade, its employees scattered, its 158 years of history ending not with ceremony, but with a court filing. 158 years. That number is the part of the story that most people miss. Because when we talk about Lehman Brothers, we almost always talk about the end, the collapse, the panic, the 2008 financial crisis, and everything it destroyed. We talk about it as though the bank was always fragile, always reckless, always a disaster waiting to happen. But that is not the true story. The true story is about what Lehman Brothers actually was before the crash, what it had survived, what it had built, and how something that had endured for a century and a half, through the Civil War, through 2 world wars, through the Great Depression and Black Monday, and the Asian financial crisis and the September 11th attacks, managed to destroy itself in less than 2 years. Before we go any further into this story, the story of what Lehman Brothers actually was, who built it, what it stood for, and why the answer to that question makes the collapse so much more devastating, make sure you are subscribed to the Talk History channel. Leave us a comment and tell us which other corporate stories you want us to investigate. Because what you are about to hear is not just a story about a bank. It is a story about America, about ambition, about what happens when an institution that has survived everything finally encounters the one thing it cannot survive: itself. To understand what Lehman Brothers was, you have to go back to 1844, not to Wall Street, not to New York, to a small dry goods store on Commerce Street in Montgomery, Alabama. A 23-year-old immigrant from Bavaria named Lehman had just arrived in America. He changed his name to Henry. He loaded merchandise onto a wagon and spent a year trading up and down the Alabama River, selling fabric, seeds, and household goods to the farming families scattered along its banks. In 1847, his brother Emmanuel joined him. In 1850, their youngest brother, Mayer, arrived. They put their name above the door of a small shop on Court Square, and Lehman Brothers was born. It was not born in prosperity. It was born in cotton. And cotton in Alabama in 1850 was inseparable from slavery. The Lehman Brothers accepted raw cotton as payment for merchandise from plantation owners whose workforce was enslaved. They traded that cotton, profited from it, and built the foundation of everything that would come after on those transactions. Mayer Lehman was listed in the 1860 census as the owner of 7 enslaved people. The brothers supported the Confederacy during the Civil War. This history is not a footnote. It is the foundation. And yet, what happened to the business after that foundation was laid is, in its own way, an extraordinary American story. Because Lehman Brothers survived the Civil War. It survived the destruction of the Southern cotton economy. It moved to New York. It helped found the New York Cotton Exchange. It pivoted from commodities to investment banking, underwriting the IPOs of Sears Roebuck, Macy's, F.W. Woolworth, and Studebaker. It helped finance Paramount Pictures, 20th Century Fox, and RKO. It survived the panic of 1907, the crash of 1929, the Great Depression, and World War II. Each time, it adapted. Each time, it found the new economy forming behind the wreckage of the old one and positioned itself at the center of it. By the second half of the 20th century, Lehman Brothers had become something that the three brothers from Bavaria could not have imagined standing in their cotton warehouse in Montgomery, one of the most powerful financial institutions in the world. That history mattered. That history was the story Lehman told about itself. And it was, for most of a century and a half, completely true. In 1993, American Express decided it no longer wanted to be in the investment banking business. It had acquired Lehman Brothers 9 years earlier, merged it with its retail brokerage arm, renamed it Shearson Lehman Hutton, and spent nearly a decade discovering that running a prestigious investment bank was harder and stranger than it appeared from the outside. So in 1994, American Express spun Lehman off. The bank went public again, its own entity, its own stock ticker, its own future to determine. And the man who would determine that future was a 50-year-old fixed-income trader named Richard Fuld. Fuld had spent his entire career at Lehman. He had joined the firm's commercial paper desk in 1969 and never left. He had watched it get acquired, watched it get renamed, watched the culture he had grown up in get diluted and confused and bureaucratized by a corporation that did not understand what investment banking actually was. And when the firm was finally spun off, when it was finally just Lehman Brothers again, Fuld's rise to the top felt like a homecoming. His employees called him the Gorilla. Not mockingly, at least not to his face. The name captured something real about the man. His physical presence, his combativeness, his absolute certainty that aggression was the correct response to almost every situation. Fuld did not do nuance. He did not do hesitation. He rewarded those who generated profit, and he punished, quickly and memorably, those who did not. Under his leadership, Lehman was transformed. In 1993, the year before he became CEO, the firm had reported a loss of $102 million. By 2006, it reported a record profit of $4 billion, $200 million. In those 14 years, revenues grew by 600%. The stock price increased by more than 300%. By 2007, Lehman Brothers was the fourth largest investment bank in the United States. It employed 26,000 people in offices across 26 countries. Its headquarters in Midtown Manhattan, at 745 7th Avenue, was a monument to its own ambition, a gleaming tower that the firm had moved into in 2002, just months after September 11th had destroyed its previous offices at the World Trade Center. That recovery from September 11th was important to the Lehman story, and Fuld knew it. The firm had lost its headquarters and one of its employees in the attacks. Within days, it had relocated its operations. Within weeks, it was functioning normally. Within a year, it was growing faster than it had before. The narrative of survival of the firm that came back every time was one that Fooled cultivated deliberately. It was baked into the culture. It was the story Lehman told itself. As long as I am alive, this firm will never be sold. Richard Fooled, CEO of Lehman Brothers, December 2006. That was what Fooled told the Wall Street Journal in December of 2006, when Lehman's stock was trading at $92 and the firm's future had never looked more certain. He had said it publicly, in print, to one of the most widely read financial publications in the world. He meant it. He had built this institution back from near extinction. He had turned a $100 million loss into $4 billion profits. He had restored the name above the door and the pride beneath it. What he could not see, what his certainty made it almost impossible for him to see, was that the very qualities that had made him so effective in the years of growth were precisely the qualities that would make him catastrophic in the years of danger. The story of Lehman Brothers' destruction begins not in 2008, when the world noticed, but years earlier, when a series of decisions were made that seemed, at the time, not just reasonable, but brilliant. In 1997, Lehman bought a Colorado-based mortgage lender called Aurora Loan Services. In 2000, it purchased a California subprime lender called BNC Mortgage, then another lender, then another. By 2003, Lehman was originating $18 billion in mortgage loans per year and ranked third in the entire country. By 2004, that number had surpassed $40 billion. By 2006, two of its subsidiaries were generating nearly $50 billion in new mortgage loans every single month. $50 billion in new mortgages every month. To put that in context, that is more money than many countries produce in their entire annual economic output. It was a number so large, it barely seemed real. And in the atmosphere of the American housing market in the mid-2000s, when home prices had risen by double digits every year for nearly a decade, when the prevailing assumption among almost every significant institution on Wall Street was that they could only keep rising, that number felt like success, not risk. The business model was elegant in its simplicity. Lehman's subsidiaries would originate mortgages, making loans to homeowners, including homeowners who, under traditional lending standards, would not have qualified. Those mortgages would then be bundled together into securities, mortgage-backed securities, and sold to investors around the world who wanted access to the American housing market. Lehman would earn fees at every stage of the process. It was a machine, and it ran beautifully, except for one thing. Lehman was not just originating and selling these mortgages, it was keeping them. Not all of them, but enough. When the market for certain classes of mortgage-backed securities was too thin to absorb everything Lehman was producing, the firm held the remainder on its own books. This was, in the language of Wall Street, a balance sheet risk. In the language of what actually happened, it was the mechanism of destruction. By the end of 2007, Lehman Brothers held $111 billion in commercial or residential real estate-related assets and securities on its own balance sheet. That was more than 4 times the firm's total equity. The bankruptcy examiner, who investigated the collapse, later described it with a precision that strips away all the complexity and gets to the simple, terrifying truth. Lehman had morphed into a real estate hedge fund disguised as an investment bank. Anton Valukas, Lehman Brothers Bankruptcy Examiner, 2010. A real estate hedge fund disguised as an investment bank. And the leverage that financed this disguise was staggering. By 2007, Lehman was borrowing $31 for every single dollar of its own equity. That is a leverage ratio of 31 to 1. At that level, a decline of just 3 to 4% in the value of its assets would wipe out everything, not reduce the firm's equity, not impair its capital, erase it entirely. 3 to 4%. The American housing market, which had never in recorded history experienced a national price decline, was about to fall by 30%. The mathematics of catastrophe were already written into Lehman's balance sheet. They just had not been triggered yet, and inside the firm, the warning signs were there. Risk managers noted the concentration. Some analysts expressed concern about the scale of the real estate exposure. Those concerns were, in Fools culture, not welcome. The bankruptcy examiner would later find in internal emails that Lehman's senior management had systematically disregarded their own risk managers and their own risk limits. Fools' response, when the crisis began to unfold, would capture the entire dynamic of the firm in a single sentence. When questioned about his 27,000 employees and whether any of them were worrying about the risks the firm was taking, he said, "Regardless of what you heard about Lehman Brothers risk management, I had 27,000 risk managers because they all owned a piece of the firm." Richard Fould, testimony before Congress, October 2008. 27,000 risk managers. None of them, it turned out, had been able to prevent what was coming. By 2007, the American housing market had begun to turn. Prices that had risen relentlessly for a decade started, quietly at first, to fall. Mortgage defaults among subprime borrowers began to rise. Two Bear Stearns hedge funds that had invested heavily in mortgage-backed securities collapsed in June 2007. The first tremors of what would become an earthquake were passing through the system. At Lehman Brothers, the earthquake was already inside the building. Because the firm was not merely exposed to a declining housing market through its securities portfolio, it had borrowed billions of dollars every single day in the overnight funding markets to keep those positions alive. It was like borrowing money each morning to pay for a house, then borrowing it again the next morning, and the morning after that, hoping that the value of the house never fell enough to frighten your lenders away. When those lenders, the counterparties who provided Lehman's daily funding, began to look more carefully at what Lehman was offering as collateral, they did not like what they saw. And when they did not like what they saw, they demanded more collateral, or they simply stopped lending. Lehman needed to project confidence. It needed its balance sheet to look healthy. It needed the leverage ratio that investors and rating agencies scrutinized to be within acceptable bounds. And so, in the final months before its collapse, the firm turned to a mechanism that had been invented years earlier but had now become existential. It was called Repo 105, and it was, in the precise language of the bankruptcy examiner, a mechanism that created a materially misleading picture of the firm's financial condition. Here is how it worked. A standard repurchase agreement, a repo, is a way for a financial firm to raise short-term cash. You sell assets to a counterparty and agree to buy them back the next day. Under accounting rules, this is recorded as a loan. The assets stay on your balance sheet, and the cash appears as a liability. Straightforward. Repo 105 was a different animal. By slightly over-collateralizing, by offering assets worth $105 for every $100 of cash, Lehman could, under a specific accounting rule, record the transaction not as a loan, but as a sale. The assets disappeared from the balance sheet entirely. The debt did not appear, and because the entire transaction would reverse after the quarter ended, because the assets would be bought back and the cash returned, none of this had to be disclosed to investors. At the end of the first quarter of 2008, Lehman used Repo 105 to remove $49 billion of assets from its balance sheet. At the end of the second quarter, $50 billion, tens of billions of dollars, temporarily erased from the numbers that the public, the regulators, and the rating agencies were being asked to trust. One man inside Lehman tried to stop it. His name was Matthew Lee. He was a senior vice president, a 14-year veteran of the firm, responsible for balancing Lehman's global balance sheet for public reporting. In May 2008, he wrote a letter to Lehman's senior management, not to a journalist, not to a regulator, to his own bosses, alerting them to the Repo 105 transactions and warning that they created a misleading picture of the firm's true financial health. The next month, Matthew Lee was let go. Fooled when asked about Repo 105 before Congress, offered a statement that has since become one of the more chilling artifacts of the entire financial crisis. I have absolutely no recollection whatsoever of hearing anything about Repo 105 transactions while I was CEO of Lehman. Richard Fould, Testimony before Congress, October 2008. No recollection whatsoever of a practice that removed $50 billion from the firm's balance sheet. A practice that the bankruptcy examiner found was known to Lehman's senior officers and to its auditors at Ernst & Young. A practice that, according to the examiner, those auditors should have flagged, but did not. No one was ever criminally charged for Repo 105. Not Fould, not the CFO Erin Callan, not the auditors at Ernst & Young, who settled a lawsuit but admitted no wrongdoing. The machine had one final act to perform. On Friday evening, September 12, 2008, the heads of every major Wall Street bank were summoned to the New York Federal Reserve Building. Treasury Secretary Henry Paulson had called the meeting. The message was precise and unambiguous. There would be no government bailout of Lehman Brothers. The firm had one weekend to find a buyer, or it would fail. Paulson had already made the calculus. He had watched the government rescue Bear Stearns 6 months earlier, absorbing the political fury that came with appearing to protect reckless bankers from the consequences of their decisions. He would not do it again. That weekend, 2 potential buyers circled the wreckage. Bank of America was interested, until it looked at the books and turned instead to Merrill Lynch, which it agreed to purchase over the same weekend for $38 billion. Barclays, the British bank, was interested until the UK financial regulator refused to waive the requirement for a shareholder vote, which could not happen before the markets opened on Monday. There was no time. There was no deal. On the evening of Sunday, September 14th, the decision was made. Lehman Brothers would file for bankruptcy when the markets opened the next morning. At 1:45 a.m. on Monday, September 15th, 2008, the largest bankruptcy filing in American history was submitted to a court in the Southern District of New York. The firm that had survived 158 years, cotton trading in Alabama, the Civil War, 2 world wars, the Great Depression, Black Monday, the Asian financial crisis, the dot-com crash, September 11th, was gone. By morning, the photograph that would define the crisis had already been taken. Lehman employees leaving the building at 745 7th Avenue, carrying boxes of their belongings, their identification badges still around their necks, walking out into a September morning that would be remembered for generations. The consequences of the next 48 hours were catastrophic in ways that no one in that Federal Reserve building had fully predicted. The day after Lehman filed for bankruptcy, the American International Group, AIG, the largest insurance company in the world, received an emergency $85 billion bailout from the Federal Reserve. AIG had insured vast quantities of mortgage-backed securities through instruments called credit default swaps. With Lehman gone, confidence in those instruments collapsed. AIG was about to collapse with them. Had it done so, the financial system's exposure to AIG's insurance obligations would have triggered failures across every major bank in the developed world simultaneously. The Reserve Primary Fund, one of America's largest money market funds, considered by millions of savers to be as safe as a bank deposit, announced that it had broken the buck. The value of $1 invested was now worth less than $1. The news triggered a run on money market funds across the country. In the space of 48 hours, $785 billion was withdrawn from money market funds. These funds were the short-term lending mechanism that companies of every kind use to make payroll, pay suppliers, and fund ordinary operations. When they froze, the transmission of credit through the entire economy froze with them. In the 2 weeks following Lehman's collapse, the Dow Jones fell by more than 2,000 points. Global credit markets effectively ceased to function. Banks stopped lending to each other entirely because no one could be certain which institution would be the next to fall. The crisis that had been building in the housing market for 2 years had, in a single Monday morning, become a crisis of the entire global financial system. $10 trillion in global market capitalization were wiped out in October 2008 alone. And yet, no senior Lehman executive was criminally charged. Fuld received nearly $500 million in total compensation during his tenure as CEO. The auditors at Ernst & Young settled claims without admitting wrongdoing. The rating agencies that had given AAA ratings to securities packed with subprime mortgages faced no consequences beyond reputational damage. The regulators who had oversight of Lehman's activities and missed, or chose not to challenge, what was happening inside the firm returned to their careers in finance and government. The Dodd-Frank Wall Street Reform Act was passed in 2010, imposing new regulations on financial institutions. But the structural features that had made Lehman possible, the too-big-to-fail problem, the revolving door between Wall Street and its regulators, the incentive structures that rewarded short-term risk and socialized long-term losses, remained, in essential ways, intact. The question that lingers over the Lehman story, the one that no regulatory reform and no congressional hearing has fully answered, is not how the collapse happened. The Bankruptcy Examiner's 2,000-page report tells us that in exhaustive detail. The question is why the institution that spent 158 years learning how to survive every crisis could not survive itself. Part of the answer is leverage. Part of it is hubris. Part of it is the specific culture that Fuld had built, a culture that rewarded the generation of profit and punished the raising of doubts, that celebrated the guerrilla's aggression and created no space for the quiet voice in the room that says, "We have borrowed $31 for every dollar we own, and the thing we have borrowed it against is falling in value." But the deeper answer lies somewhere else. Because Lehman Brothers' collapse was not the failure of one reckless institution. It was the failure of a system. The banks that survived 2008 did not survive because they were more honest or more prudent than Lehman. They survived because the government chose to save them, because the particular sequence of events played out in a way that put Lehman in the line of fire first, because Paulson made a decision that weekend in September that was, in the end, one man's judgment call, and judgment calls of that magnitude should never rest on one man's judgment. The people who lost their homes in the years after 2008 did not lose them because they had been reckless. Most of them had done exactly what they were told to do: take out a mortgage, buy a house, build equity, trust the institutions. The institutions had failed them. The institutions had borrowed $31 for every dollar they owned, had hidden $50 billion of bad assets at the end of each quarter, had paid their executives $500 million for 14 years of profits that were partly illusion, and had then asked the public to absorb the consequences. The public absorbed them, as it always does. The name Lehman Brothers no longer appears on any building. The firm is gone. The men who ran it have moved on to other things. And the system that produced them is still there, still functioning, still looking for the next thing it can afford not to understand. Thank you for watching all the way to the end. If this story stayed with you, if you found yourself asking questions it doesn't fully answer, then subscribe to the Archives Untold channel. Every week, we find the stories that the official version leaves in the dark. Leave us a comment. Tell us which company's hidden history we should investigate next. See you in the next video.